Welcome to Dime Dive. Are you on the hunt for the best low-cost, high-return way of investing in stocks? Welcome to the world of investment strategies where understanding your options can make the difference between financial success and failure. Today we're going to delve into the realm of low-expense ratio broad market mutual funds and ETFs. These investment vehicles might just be the key to unlocking your financial potential. Stay tuned to discover a smart, cost-effective approach to investing in stocks. Imagine owning a small piece of top publicly traded company in the United States. Sounds impossible, right? Not with low-expense ratio broad market index mutual funds. Now let's dive into the world of mutual funds, specifically broad market index mutual funds like a big basket. This basket contains different types of investments, primarily stocks. Now, broad market mutual funds take this concept a step further. Instead of focusing on a specific sector or type of stock, they aim to replicate the performance of a broad market index. This means that when you invest in a broad market mutual fund, you're essentially investing in a wide range of sectors and companies. This approach has its benefits. For starters, it provides a level of diversification that's challenging to achieve on your own. By spreading your investments across a wide variety of stocks, you can potentially reduce risk. It's like the old saying goes, don't put all your eggs in one basket. But there's a catch, and it's called the expense ratio. This is the annual fee that all funds charge their shareholders. It represents the percentage of your investment that goes towards operating expenses. So, the lower the expense ratio, the less you pay in fees, and the more of your money gets invested. Here's where low expense ratio index mutual funds shine. They typically have lower expense ratios than other types of mutual funds. This is primarily because they are passively managed, meaning they simply track the performance of a market index rather than trying to outperform it. But like all investments, index mutual funds are not without their drawbacks. The primary one being that your potential for high returns is limited to the performance of the market index. So if the index performs poorly, so does your investment. But over time, index funds have outperformed most managed funds. So with low expense ratio, broad market mutual funds, you not only diversify your investments but also keep costs low. This way, you're better positioned to make the most of your investments. After all, it's not just about how much you make, it's also about how much you get to keep. But what if there's a more flexible option? Enter exchange-traded funds or ETFs. ETFs, similar to mutual funds, are investment vehicles that pool together funds from many investors. They are designed to track the performance of a specific index, sector, commodity, or asset class. What sets ETFs apart is their ability to be bought and sold like individual stocks throughout the trading day, offering real-time pricing and the flexibility to get in and out of positions as you see fit. Mutual funds are bought at the closing price for that day. Mutual funds are a bit like a set menu at a restaurant where you get a pre-selected assortment of dishes for a set price. ETFs, on the other hand, are more like a buffet. You can pick and choose what you want when you want it, and you can go back for seconds or even thirds if you're so inclined. Furthermore, ETFs often have comparable expense ratios than mutual funds, which means you get to keep more of your hard-earned investment returns. This is due to the passive nature of most ETFs, which simply aim to mimic the performance of their underlying index rather than actively trying to beat the market. In a nutshell, ETFs offer the best of both worlds. They provide the diversification benefits of mutual funds while also offering the flexibility and control of individual stocks. ETFs give you the control of a stock and the diversity of a mutual fund, all at a low cost. Let's recap what we've learned so far about these smart, cost-effective investment strategies. We've delved deep into low-expense ratio broad market mutual funds, uncovering their ability to provide a diversified portfolio at a lower cost. This offers a fantastic way to be a stocks guru without the need for extensive market knowledge. So if someone asks you what you think about Nvidia stock, you can say, I don't know and I don't care. We also explored the world of ETFs, an alternative to mutual funds. These are ideal for those who want more flexibility, as they can be bought and sold throughout the day, just like individual stocks. Both these investment strategies have their unique advantages, and it's about finding what fits best with your financial goals and risk tolerance. By investing in these low-cost options, you're able to maximize your potential returns and keep more of your hard-earned money. Remember, the goal is not just to invest, but to invest wisely. And with these strategies, you're well on your way to making the most out of your stock investments. Check out the next video on zero expense ratio funds. Subscribe to Dime Dive.